Big news in housing news this week. President Donald Trump has proposed the idea of 50-year mortgages, sparking a heated debate across the housing market. According to the Federal Housing Finance Agency, Director Bill Pulte has confirmed that his team is actively studying how a 50-year mortgage term could work. Yes, a loan that lasts half a century. The goal sounds simple: stretch the loan, shrink the payment, make housing feel affordable again. Because while the 50-year mortgage could help millions finally buy a home, it could also rewrite how Americans build wealth, manage debt, and even retire. So, in this video, we're going to unpack exactly how this works, who it helps, who it hurts, and whether the 50-year mortgage is the key to saving the housing market or the start of an even bigger problem. Right now, housing affordability is the worst it's been in decades. According to data from the National Association of Realtors, the average home price in the U.S. hit nearly $420,000 in 2025. At the same time, average mortgage rates have hovered around 6 to 6.5%. For a typical household earning the U.S. median income, about $83,730 per year, based on Census Bureau data, the math just doesn't work. Monthly payments on a standard 30-year mortgage often eat up to 40% or more of their income. That's well above the recommended 30% threshold for financial stability. Let's start with the upside of 50 years loan. If you take a $400,000 mortgage and stretch it from 30 years to 50, your monthly payment drops fast. At a 6.5% interest rate, a 30-year loan costs about $2,528 per month for principal and interest. At 50 years, that same loan falls to around $2,200. That's over $300 saved every month. For a family living paycheck to paycheck, that's a game changer. That's the difference between getting approved or being denied. So in theory, the 50-year mortgage opens the door for millions who've been locked out. It gives people breathing room, it gives them hope, and it makes home ownership feel possible again. If the policy actually becomes law, lenders will likely follow fast. That means more options, more competition, and potentially better rates for borrowers. Back in the 1930s, during the Great Depression, the 30-year mortgage itself was a radical idea. Before then, home loans were usually only 5 to 10 years long, often with a massive balloon payment at the end. The government extended those terms to make buying homes easier, and that move changed American life for generations. Supporters of the 50-year term are now arguing that we need a similar reinvention today. If you like simple money stories that explain big financial news in plain English, go ahead and like this video and subscribe for more. All right, here's the other side of the story. That lower payment doesn't come free, because the longer you take to pay something off, the more interest you pay in total. According to an analysis by Bankrate, a $400,000 loan at 6.5% interest would cost about $592,000 in interest over 30 years. Stretch that to 50 years, and total interest skyrockets to roughly $926,000. That's an extra $334,000, just for the privilege of smaller monthly payments. That money doesn't go toward your home, it goes straight to your lender. So while your payment feels easier, your long-term wealth takes a massive hit. And there's another hidden cost: slower equity. Equity is the portion of your home that you actually own. It grows as you pay down the loan. But in a 50-year mortgage, most of your early payments go toward interest, not principal. That means after 10 or even 15 years, you might still owe almost the same amount you borrowed. According to data from the Consumer Financial Protection Bureau, most 30-year borrowers have built at least 20% equity after their first decade. But under a 50-year term, that could be closer to 5 or less. Because if you need to move, sell, or refinance, you'll have very little cushion. Even a small dip in home prices could put you underwater, meaning you owe more than your home is worth. There's another layer to this: market dynamics. When more people can suddenly afford higher-priced homes, demand rises. And when demand rises without more supply, prices go up. That means the affordability benefit might not last long. As more buyers flood the market with new purchasing power, sellers can raise prices again. So while your monthly payment may shrink, the actual price you pay for the home might climb. Then there's the legal side. Right now, the U.S. has something called the Qualified Mortgage Rule. It was created after the 2008 crisis to protect borrowers from risky loans. One key rule is that most qualified mortgages can't exceed 30 years. That means a 50-year mortgage, as it stands, would likely fall into the non-qualified category, so there might be some changes to this rule. The good news is that this 50-year loan may make sense for some. It could help younger buyers who expect their income to rise fast. It could also stabilize payments for households that value flexibility over rapid wealth building. If used carefully and with full understanding, it's just another financial tool. But people need to keep in mind that extending loan terms can solve short-term affordability, but risks inflating prices and weakening long-term wealth building across generations. That's because most homeowners don't hold their mortgages for 50 years. They sell or refinance every 7 to 10 years on average. So most borrowers will never reach the end of that term. They'll just spend longer in the expensive, interest-heavy phase of the loan. That's like running on a treadmill that keeps speeding up. You're paying, but not really getting ahead. But future income growth will balance this out. If you expect to earn much more 10 or 20 years from now, then a lower initial payment might make sense. You could always pay extra later. Most modern mortgages allow prepayment without penalties. But as we all know, life doesn't always go as planned. Job loss, inflation, or family changes can stretch even the best budgets thin. Still, there's a scenario where this works beautifully. If the 50-year term is used only for specific cases, like refinancing struggling borrowers or financing new affordable housing developments, it could provide real stability. It could help people avoid foreclosure. It could let developers build more units at lower monthly carrying costs. That's where this tool might shine. So, what happens if we go forward with this? Expect more people to buy sooner? Expect more debt across the system? Expect home prices to rise slightly? And expect wealth inequality to widen, because those who already own homes will see their values climb even higher. Meanwhile, first-time buyers will take on longer, heavier debt to join the club. The bottom line is, a 50-year mortgage can make homeownership feel possible again, but it also extends financial pressure over most of your lifetime. Thank you for watching. Please subscribe if you like to watch more simple money stories like this.